It's Matty Loans, your mortgage master of puppets. 2024 is finally here. Is buying a home on your New Year's resolution list? If you plan on using a loan to buy that home, great timing. See, there's more to the mortgage market than up and down, and we often blame the Fed as the culprit for higher or lower mortgage rates. Truly, mortgage rates are influenced by a combination of factors including market conditions, investor sentiment, and economic indicators, to name a few. Let's remove the mask on a few major influencers and how they shape the market we participate in. Prospective buyers and borrowers should stay informed about these factors and work closely with mortgage professionals to understand how influencers shape the rates they receive. Now, let's break it down from boulders to sand. The Federal Reserve plays a critical role in influencing short-term interest rates. Changes to the federal funds rate, which controls everything from the prime rate to the interest rate at which banks lend to each other overnight, will impact the borrowing environment. When the Fed raises or lowers the Fed funds rate, it affects the cost of borrowing for banks and in turn impacts interest rates that consumers see on various loans like auto loans, credit cards, and mortgages alike. And this one's obvious, but there are several other ways the Fed acts as a master manipulator. The Fed participates in what they call open market operations, and they use that to buy and sell government securities, including T-bills, bonds, notes, as well as mortgage backs. When the Fed buys securities, it actually supplies capital to the market, potentially lowering rates. But when it sells, it withdraws capital from the market and can stimulate borrowing costs. See, the Fed supports the majority of the market, and recently they made a significant change by increasing the loan amount to the size of the loan they will actually purchase, up to $766,500 in most places. Okay, this one is my favorite, quantitative easing. It's like the open market operation, but with a turbocharge, twin turbo. It involves purchasing financial assets like mortgage-backed securities, thus creating demand, increasing the value, but in turn downward pressure on their price. Simply when the Fed adds or subtracts mortgage-backed securities from their balance sheet, it'll increase or decrease mortgage rates accordingly. During the pandemic, when the Fed announced unlimited support for the market, that was QE and the reason why rates continue to decline even after they stopped cutting rates. But wait, there's more. The Fed can also set the tone through its testimony and communication through its intentions and monetary policy guidance. This guidance can impact the market expectation when it signals a commitment to keep rates the same, higher, or lower. A great example of this was pre-pandemic and during the pandemic when rates began their descent, which started way back in December of 2018. Rates began their slide without the Fed doing much of anything from a rate standpoint and continued to slide well after when they gave unlimited support to the market during 2020. Rates declined from 19 to 20 and from 20 to 21 when they hovered right about 3%. So there's more to the Fed than simply increasing or decreasing the rate itself. It also matters if they're a buyer or seller or the composition of their rhetoric. Fed speak. I know, Maddie, but isn't this what the 10-year Treasury's for? And a lot of people in the business look to the 10-year note as a proxy for mortgage rates. And yes, it can be helpful, but I don't think it does justice like the actual mortgage-backed security market. And like the Fed, it has a correlation to the market, as we just mentioned, because the Fed can influence the market through purchasing mortgage-backed securities. And if you've heard of the term MBS, it's basically pools of mortgages that get sold to an investor, and as the supply or demand for these securities change, so do the yields and thus the mortgage rates you receive at closing. Factors such as market sentiment, investor demand, and economic indicators contribute to the fluctuation in the MBS market. And you can look up coupon prices in real time, just like any other stock. I like to use Mortgage News Daily to see what's going on in real time. The bigger picture, and in the context of housing and mortgage, is that the MBS market provides liquidity to lenders by a safe haven to dump these loans. Essentially, they can then free up the capital and move on to the next deal, while the investor receives an ROI based on the performance of the underlying loan. When you go to a bank to borrow money, it's important to remember they're not lending their actual money. They're providing funding for the transaction pre and post closing until it's delivered to an investor like Fannie or Freddie, and then into the form of an MBS. So the predominant entities, again, are of the GSEs, Fannie Mae, Freddie Mac, and these entities play a critical role in supplying the mortgage market with a guarantee that they'll be purchased, and thus stability. So when the bank offloads your mortgage, it takes that money and lends it out all over again, and the cycle continues. A great example of this and how the MBS market works was back in 2021, late in the year, when the GSEs reduced their tolerance to purchase second investment mortgages. As a result, there was a widening spread between the rates you received on a primary and secondary home. Before this, you could likely get the same rate for a primary and second home, or pretty darn close. Now the second home rate mimics more like an investment rate, and it's been that way ever since. So to attract investors to second home purchases, the yields went down, the prices went up, and that's what we're seeing for these type of mortgage-backed securities. Daily interest rates change based on inflationary market pressures, such as economic indicators that are inflationary related, like the unemployment reports, payroll and the unemployment rate, and inflationary reports such as the consumer price index and producer price index can impact day-to-day swings with mortgage rates. If these indicators provide positive economic news, it may lead to expectations of higher inflation and higher interest rates, potentially pushing mortgage rates along with the tide. Conversely, weaker economic indicators may contribute to lower inflation and likewise lower interest rate expectations. Since inflation erodes purchasing power of money over time, lenders will have to adjust mortgage rates to account for inflation expectations to maintain positive real interest rates. Nominal interest rates are represented by the stated interest rates on mortgages, but real interest rates adjust for nominal interest rates for inflation. Higher inflation and higher mortgage rates are exactly what we're seeing from 21 through 2023, due mainly of the $6 trillion in stimulus. Now, one would think the unemployment rate would be a bigger influencer than the non-farm payrolls, as not having a job makes it hard to pay pretty much everything. But actually, it's the non-farm payrolls that have a greater impact. This report measures the total number of workers employed in the U.S., and changes in the non-farm payroll impact consumer spending and growth, a barometer of inflation, and thus changing mortgage rates. A great example of this was just last week when we had a hot CPI and a flat PPI. Now, one would think that the hot read on consumer inflation would rattle the mortgage market, but it didn't. As seen here, rates went higher. This is during 2023 from May to June, June to July, July to August this past year, along with the CPI. However, last week, we had a CPI come in hotter than expectation, and rates just didn't respond. Very important, lenders will incorporate inflationary reads to their risk model assessment. Higher inflation can increase the risk of lending and demand higher rates in return as compensation. Often we'll see lenders decrease their rates with a greater amount of down payment, higher credit scores, or a lower ratio for debt service. Likewise, if you're putting less down, have a lower credit score or higher debt service ratios, one or a combination will increase your risk-based pricing and increase your rates accordingly. These factors are known as adjusters and can impact the risk price of your loan and ultimately determine the rate or fees you're going to pay. It's important to note that these indicators are interconnected, and mortgage rates can be influenced by a combination of factors. Additionally, market participants may differ on their interpretations of this economic data, and global economic conditions can also play a role in mortgage rates day to day. Refer to these influencers when doing your research and deciding if now is the time to act on your mortgage. Bye-bye, Maddie out.